And as people log in, they can join the webinar as it is going on. At the end, I'm going to allow everyone to talk. I apologize for maybe not having it so interactive, but if you just hold your questions till the end. So we are going to, this is our Capital Markets 2026 presentation. We attempted to have it in the office last week, but I'm happy to report that with postponing it to this week and doing it in this format, we've more than doubled the people that were able to attend. So maybe that's some feedback we can get from you, our clients, on what's most effective for you in attending some of our seminars. We try to do the traditional in-office for this one, but you know, with the new world we live in and webinars and Zooms and everything else, maybe it's just people are more comfortable or maybe even more used to doing it in this format. But also, before we get started, I did want to recognize a member of our team, Michelle Stewart, who actually just finished her enrolled agent certification. She finished 3 tests. She's been studying for it for over a year. And so congratulations to her and to us for her being a member of our team here. And as an enrolled agent, not that any of our clients would have this situation, but as an enrolled agent, she can represent or sit in front of the IRS and help our clients with specific IRS issues to the IRS. So big congratulations to her. We're going to do our traditional presentation. I'm going to walk through US and global equity markets. I'm going to walk through hopefully some educational slides on the inability to time the market. It always seems like there's something going on in the market where people are concerned about the direction of the markets, and we just want to reiterate the impact of trying to time the market, get in and get out. We'll go into some fixed income. We'll share some slides on interest rates and the Fed, and then share some economic slides. And I've got 37 slides here. So if I just spend a minute per slide, I've got you for 37 minutes, but I promise we won't take that long. It's a heck of a balance to try to share relevant information with you at the same time, being cognizant of the time that you dedicate to us and participating in things like this. So very much appreciate your time, and let's go ahead and get started. So to start, here's the kind of a historical performance of the S&P 500 or the U.S. stock market as measured by the S&P 500 index. You can see that year to date, we're up 0.5%. And, 19 days in, I think I think everybody would agree it's been a back and forth kind of environment. I think, just as evidence of that, this is the S&P 500 index, but the NASDAQ, which is more tech oriented, and of the 3 major indices between the Dow, S&P, and the NASDAQ's down 2% year to date, but the average stock in the NASDAQ is down 20%. And as I'll talk about in a few slides, a 20% from a prior high, that's actually considered a bear market, or, the stock would be in a bear market position, down 20% from prior peak. I think, all the major banks have put out forecasts somewhere between 7,200 and 7,750 for the S&P 500. As we sit here, as I look up at the monitor here right now, we're about 6,800. So let's call it a 1,000-point move from here, which would be a little bit more than 10%. I think supporting that, in addition to some of the economic slides we'll get into, is earnings growth. Earnings forecast for this year is expected to be about 15%. Next year, it's expected to be at least double digit, somewhere around 10 to 11. So there is some fundamental support for where the market is right now. And we also would expect a positive market, U.S. equity market for 2026. The question mark is really how we get there. What is the path that we take to get there? I thought it'd be useful to maybe look at the Magnificent Seven's contribution to the S&P 500 over the last few years. So what this slide is, it is indexed to 100 starting in 2020 or since 2020, so 2021 through today. And it's the Magnificent Seven. You can see those at the top of the slide there. What constitute that? I think interesting also, this is just an equal weighted Magnificent Seven. As a reminder, the S&P 500 is a market cap weighted index. And matter of fact, the Magnificent Seven represents a all-time peak, or at least it was coming into the year, about 35% of the S&P 500. But what does index to 100 mean? Essentially what you're doing is you're looking at the 5 numbers we have to the right of this graph of the Magnificent Seven, the S&P, the NASDAQ, the Dow, and the equal weighted S&P 500. So if you have basically invested $100 today in the Magnificent Seven, you would have $200. In the S&P 500, you would have $76. So that gives some context to the growth in the Magnificent Seven. And in fact, since 2003, the Magnificent Seven is up almost 300%. And so if you're just looking at the S&P 500, I think it's really, really important to consider how it's constructed and what's driving that. As a matter of fact, year to date, the Magnificent Seven ETF, yes, there is such a thing. The Magnificent Seven ETF is down 6.5%. The equal weighted S&P 500, so just taking the S&P 500 companies, constituents, equal weighting them versus market cap weighting them, that's up 6.3%. And as I've said from the prior slide, the S&P 500 is up 0.5%. So you see a broadening of the market here and away from the Magnificent Seven, which is a healthy thing. Also, as far as earnings contribution, the Magnificent Seven, while still positive and attractive from an earnings growth perspective, the other participants, the other 493 stocks are contributing a little bit more to that 15% earnings growth in 2026, again, which is also positive. I think a fun note to get in here too is if you've never heard the word hyperscaler, that's essentially the Magnificent Seven. These are the companies that are spending enormous amounts of money building all these data centers for the the AI, the alternative intelligence, artificial intelligence, wave, and how that's going to change just about everything we do, at least if you buy into everything that's being said. But just for 2026, so for we just finished the Q4 earnings, essentially. We still got retail to go, but finished the Q4 2025 earnings. So everybody's kind of given forecast for 2026. And the hyperscalers are forecasted to spend $700 billion in 2026. And as a thought, I thought, how many companies are bigger than $700 billion? And I can tell you that there's 12 US listed companies that are bigger, market cap, that are bigger than $700 billion. 8 of those 12 are directly associated with the hyperscaler spend build out. And I think the other 4, if you ask them if they're participating in artificial intelligence, they would tell you yes, but they are not part of the hyperscalers. And just for trivia night, the 4 companies that of the 12 that are larger than the CapEx spend for these companies are Walmart, Berkshire, Eli Lilly, and JP Morgan. But massive amounts of money being spent in data center construction. That's also what's interestingly driving recent volatility in the S&P 500. One, how are we going to earn returns on this $700 billion? And again, that $700 billion is just the 2026 number. There are hundreds of billions of dollars spent last year. And so that's really pressuring some of the Magnificent Seven. But at the same time, we're seeing the artificial intelligence scare leak into some other industries here over the past couple of weeks, which is an interesting dichotomy where the market is, one, questioning the spend on the use of artificial intelligence, but then also suggesting that artificial intelligence is going to take over all these other industries. And so you have positive expectations for artificial intelligence, but pressure on the same people that are generating or formulating or building the artificial intelligence models. So interesting dichotomy there. So we've talked a lot about price so far. What are we talking about? Value. So here is just one metric that's used in determining, trying to gauge the value of the market. So this is the S&P 500 forward PE ratio. A lot of literature is written of where we are today relative to the tech bubble, which was 24.5 that you can see right there in red. We're at 21.8% now, or 21.8 times now. Certainly on the high end, but I wouldn't compare the current 21.8 to the 24.5 because the extreme extent to which all of that was internet-based and interest rate levels were different relative to where they are today, meaning lower interest rates, support valuation, higher interest rates drag down equity valuation. So a little bit of difference there. I think for 2026, we don't expect there to be much multiple expansion. So there's two reasons why stock prices would go up: multiple expansion and earnings growth. We've talked about earnings growth being 15% for 2026. So even if you leave the multiple flat, so 21.8 times, and you got earnings growth of 15%, that would suggest that you would have 50% upside. Where we've seen particularly outsized performance, at least as an example, the last 3 years, you've had both multiple expansion and earnings growth. Could be a little bit of a complicated slide here, but just wanted to give you context on other valuation metrics that are used in the market. So along the bottom here, you can see price to earnings. You see price to book, price to sales, price to cash flow, and dividend yield. Also, this kind of is a different look at it, and the number of standard deviations away from the mean for each one of these metrics. But I think the picture tells the story on the distribution of this, is that similar to the price earnings ratio absolute basis, from a standard deviation above the mean, meaning we're basically at high marks for each one of these metrics. And the blue diamond would be where we are today, and the orange X or red X, however you want to look at that, that would be where we were a year ago. So each one of these metrics is essentially 2 standard deviations above what the mean or standard or kind of normal valuations would be. So something to keep in mind. The S&P 500 is broken into 11 sectors. And this gets to the reason I wanted to show this. It gets to the broadening or the rotation out of the leaders of the market over the last couple of years, and shows these 11 sectors in the performance year to date. So on the green side, you see energy, materials, and industrials. Those are really related to kind of positive economic growth expectations. So they're very positively cyclical type industry or sector, companies within those sectors. Energy's got a bit of a twist to it, and that you got some geopolitical aspects to the performance of energy year to date. But the reason I left out consumer staples is because that's the opposite of those 3 sectors from a why is it positive perspective. And consumer staples, you think of that as shampoo, toothbrushes, toothpaste, cereal, bread. So obviously hopefully what that sounds to you is that's defensive. So those 4 sectors are leading. And then you see the red here, the COMM, communication services and technology. That's essentially the Mag 7. So they're actually underperforming. Consumer discretionary is underperforming, and financials. But right there in the blue bar, you see the 0.5% up. So these are the pieces that make up the S&P 500 from a sector perspective. And this is from a sector perspective, earnings growth and multiples for each one of those sectors. So the blue bar, just to get back to where we're discussing and kind of set your eyes here, the blue bar is the S&P 500 at 21.8 times PE multiple and 15% earnings growth expectations. So if we look, hopefully my mouse is visible, you can see here technology. I mean, it's still got a very positive earnings expectations of 29.5% essentially, but even materials is 21.7, industrials is 14.5, utilities is 11.4. So you're seeing, some of these other sectors really contribute to some of the earnings, this 15% earnings growth for the S&P 500. And so this is where you're seeing some of the valuation and earnings growth expectations for the individual sectors of the S&P 500. I mention this every year. We have this conference or this webinar or this discussion, however you want to phrase that. If there was one slide I was going to show you, our clients, about where the market, the U.S. equity markets are at any given time, I highlight this slide. So the dark blue line is the S&P 500. The shaded light blue area it represents earnings. And now, obviously, in the near term, the market is a voting machine. In the long term, it's a measuring machine. This would be a longer term comment that really stock prices are going to follow earnings. And wherever you see the blue line, the dark blue line getting above earnings is where I would argue you've got an extended market. So the market prices are getting far above what fundamentally should be driving them. And so even at 21.8 times, which was the PE ratio slide we had a few slides ago, I mean, you can see the blue shaded area is about matched up with the S&P 500. And well, it's nowhere near as attractive as maybe this environment where the earnings growth, the market just pulled away. So this is the Liberation Day, by the way, or excuse me, this is COVID. This is Liberation Day right here, last year in April 2024. This is obviously a clear buying signal opportunity. But the point here is just the market is not extended. There is fundamental support for where we are in the S&P 500, at least. Switching to outside the United States, where we are, we can see that, and again, now this isn't ideal. This isn't apples to apples. Again, this is indexed to 2020 or for the last 2 years. So again, think of $100 invested. What would you have at the end of this line? You would have $152 in emerging markets. And if you do want to notice, all of that, really all of the emerging market separation has come almost essentially year to date with the weakness of the dollar, frankly. Developed non-US markets are starting to perform also. I think you can see that here at least a little bit, where the S&P is up 38 over these 2 years. But emerging and developed are performing better than the US markets here year to date. Part of that is valuation driven. So similar to the US market where we discussed, you had the price levels. Here's where the valuation is. We have the 21.8 times for the US. In developed markets, there currently price is 16.3 and 13.1. If you know nothing else, clearly those numbers are less than 21.8. So it would appear to be more attractive. But as a reference, the US market average is about 17 times earnings. So still, even from an average perspective, these are theoretically cheaper. Now, one caveat to that, in which I would highlight in any discussion you have about indices or ETFs or mutual funds or anything, look under the hood and see what's in it. And the reason I make that point is non-US developed market indices, so the MSCI EFA index, I would call that's made up of more what I would call traditional economy type companies. So, there's not a big tech wave in the EU like there is here in the United States. So they don't have an equivalent Mag 7 driving their market or their indice. Banks, industrials, manufacturing, there's a lot of those. So just from that perspective, fundamentally, those markets should be a little bit cheaper than ours based on what's contributing to that. But nonetheless, it is an area that looks to be a little bit more attractive relative to the US. So now I want to switch a little bit to market timing and market volatility education. So this is something we like to show also every year. So what this slide shows is the S&P 500 total returns. So the blue bar and the number above the blue bar, and I know there's some bars that are negative, but essentially the numbers at the top of the graph, those are the year-end, calendar year-end returns for the S&P 500. The orange dots are at any given point during that calendar year, how much the S&P 500 was down. So as an example, 2025, fantastic year. We were up 18, but that doesn't change the fact that, matter of fact, in April, we were actually down 19. And if we use 2023, which we were up 26%, even then, at one point, we were down 10. And so when we get into the discussion of market timing, and I mean, I can promise you, and I know because we are feeling it too here. At any given point when the market's down 19, it doesn't feel good at all. But were you to exit the market because the market was down a number that just you didn't feel you felt comfortable with, obviously, while the market was down 19 and ended up being up 18, that's a massive rebound that you would have missed simply because you were saying that the market was down. And then you just take that number and human nature, well, in the future, this is what it's just going to be. That's a pretty difficult way to look at things and kind of a wrong way to look at things. And just I'll point out some things here. So we just look at 19, 20, and 21 here. So in 19, we're up 31, 20, we're up 18. That was COVID year, by the way, minus 34 during the year, and up 29. Well, if you just took those 3 years, you're up 100% combined. And in 20, 23, 24, and 25, you're up 85% on a compounded basis. But look at some of these negative numbers here along the way. And as we get as we have conversations with clients, and this year is no different than any other, but I guess the way to phrase it is in this market environment we're in, how am I going to be protected? And I'm just I want to put it in perspective the downside. I mean, if you look at where some of these downside numbers are relative to where you ended up for the year, having that longer term view really is helpful. And quite frankly, the worst time on this graph you see here was the dot-com bust. So 2020 or 2000, excuse me, we were down 9. 2001 down 12, 2003 down 22. Well, that's obviously not good. But we field a lot of questions about, what happens if the market crashes? I don't have time to recoup my assets, or, I just feel that there's going to be a correction, or when the market really sells off, things like that. The questions are phrased in those terms across this graph, which goes back to before 1990. You can see there's really only been one period where there's been an extreme and consistent downdraft to the markets. And even there, that basically is equivalent to being down roughly 40%. But were you to get out of the market in 2009, you would have been out at 27% when the market was up 26. And just to review some vocabulary, a market correction. So when you call and ask questions, I'm afraid the market's going to be in a correction. Well, just to be clear, a correction is down 10% from the prior peak. And a bear market, as I talked about before with the NASDAQ, that is being down 20% from a prior peak. I don't think you should not expect there to be various corrections throughout a year. And our next slide shows how we get halfway there on average 4 times a year. But market volatility is normal and not, the odd is not unknown. Here's another side we like to talk about, the average pullback. So this is the number of 5% pullbacks in the S&P 500 in any given year. So as an example, in 2026, we've had 0. 2025, we had 6. The average is almost 5, so 4.5. And so, market pullbacks are great opportunities to put idle cash to work, add more to companies that you really like. These are really driven. This is where the market is a voting machine in the near term, where momentum and perceived risk, near-term risk, really drive, quick decisions on sales to protect assets. And quite frankly, if you're in it for the longer term, great opportunities to pick up great companies at great prices. This is something we like to show specifically to timing the market. So this is over the last 25 years. I respect that is a heck of a long time. I don't know of anybody that can fundamentally say they've got a 25-year investment horizon, but that is over the long term. It is, just for a math perspective, if you consider 250 trading days a year, 6,250 trading days. But the reason I like this is this, a 2% market pullback. So we just talked about how there's 4.6% on average pullback, 5% pullbacks in the S&P 500. This is a 2% pullback. And the green bars, if you never touched your money over that 25 years, and the blue bars are taking your money out of the market, because there's two decisions. This is important, the two decisions when you get out of the market. One, it's time to get out. Two, when do you get back in? And I just like this slide because it really just shows what would seem to be pretty reasonable timeframes after a 2% pullback to get back into the market, and over a 25-year period, what that would do to your portfolio. And just waiting a week, it gets almost cut in half. Waiting 1 quarter gets cut almost by 2/3. So I just think that's a fascinating slide, and something that I think the average investor probably thinks about on a regular basis on a 2% pullback. Here is if you missed how many of the best days over the last 25 years and how that impacted your portfolio. Again, so I don't want to read this to you, but if you got out of the market and you missed the 5 best days, a $6,000 portfolio becomes $3,500, $3,600, well, $3,700. Certainly missing the 10 days, you get cut in half. So just try to keep this in perspective as you think about wanting to get out and when to get back in. Here's another example of buying and holding. So this is after the financial crisis, holding the S&P 500. So the financial crisis would be in the gray bar. And there's essentially 3 outcomes here. Starting in 2010, you bought and held, you moved to cash for 1 year, or you moved to cash entirely. And you certainly see the difference in performance here. And coming out of what, at least in the most recent near term, a very significant and relevant financial pullback for the global markets. Switching a little bit to fixed income. Here we see some performance, the performance for fixed income, the U.S. aggregate index, bond index. So this would be just essentially every U.S. fixed income instrument. That's up about 6% since 2020, or 7%, excuse me, since 2020. Corporates doing a little bit better. Corporates alone. I mean, a lot of that has to do with just the extreme performance and quality, meaning lack of defaults. High yield, I like to share with our clients the vernacular and words chosen in our industry. High yield, just so you know, those are essentially what used to be called junk bonds. So let's not scare investors, and let's just change it to high yield bonds, and they won't recognize that these are those junk bonds that are the same bonds, just we call them something different. But similarly to corporate bonds over the ag, high yield bonds have been extremely high credit quality, or at least lack of defaults. So these have performed really well. Just a quick note, I wanted to bring your attention to the graph here for 2022 to 2023. I think there's a general, at least in my opinion, talking to clients, there's a general belief that fixed income securities do not go down in value, that they're stable and you just clip your coupons. Well, for the most part, but 2022, and we'll talk about it, this is really when the article started being written that the 60-40 portfolio is dead, because both equities, so I'll remind you, equities were down. Let's go back. Sorry. 2022, the equities were down 18 right here. And here you see fixed income went from very positive to very negative. I believe at one point the ag index was down 20% mid-year in 2022. So something to keep in mind. Bond values go down as well. Similar to the U.S. equity market, I wanted to show where so this same type of graph for the S&P 500, this is bonds, where it ended in the drawdown at its peak. So as an example, 2022 here, the bond market was down 13%, with an equity market down 18, but at one point it was down 17. So maybe I was off a little bit there. But in general, let's pay attention. There are 1, 2, 3, 4, 5 blue bars that are negative for the year. So this is where the perception comes from that bonds are more stable than equities, and certainly are maybe stable in general and don't go down in value, because for the most part, they do help equity portfolios with diversification. And your largest your largest drawdown any given year is pretty manageable, short of 2022. So I would argue that the 60-40 portfolio not only wasn't dead, but has never been dead. It shows that there's, for those that look for certain conservatism, bonds do well. Similar kind of graph here. I don't want to belabor it. The blue bar is the S&P 500. The yellow/orange gold bar are bonds. Here you see that there are 1, 2, 3, 4, 5, 6 blue bars that are negative without a negative orange/gold bar or yellow bar. That tells you that fixed income is doing its job. Here you see the 2020 phenomenon where both the S&P 500 and the US Ag were meaningfully negative and impacted portfolios. Interest rates, this is the 10-year and the 2-year. There a lot of attention is paid to the spread of these two numbers. Also, the 10-year, for your knowledge, that's really this 4.09. This is really the interest rate that's used to evaluate or to set, or it is the foundation for most lending rates. That includes car loans, mortgages, and credit cards. So as that moves, those rates will move. Here is your treasury yield. So this is by maturity. So think of treasuries, the short term on the left, long term on the right. Typically, you would have a kind of parabolic, so starting low, essentially, if you think about it, if you're going to lend money to somebody for a short period of time, you're probably going to, if you wanted to charge an interest rate, it should be less than what you would charge somebody for a 30-year, lending money for 30 years. But this is the dynamic that we've been talking about for a number of years, quite frankly, this inversion of the yield curve. This is where you're willing to lend money at higher rates for 3 months than you are for 2 years. That has historically been an indicator of recession. We've yet to have one of those in this time frame of an inverted yield curve. The blue line here is the latest yield curve. The yellow is last quarter, and the red is 1 year ago. Here's the Fed funds rate, where it has been historically and where it is now. It's probably way too close to see, but this diamond is where we are right now, and you can see 2025 right here, 2026. This is the real question mark. Are we going to have more rate cuts this year? Very dynamic discussion with a new Fed chairman who is expected. So Powell's term ends in May. There will be a new Fed chairman. I'm pretty sure of it. And just how independent that Fed chair will be relative to the presidential influence, we'll have to wait and see. But I think currently the guess is that there'll be 2 more cuts for 2026. This is released, I believe, once every 6 months. So twice a year, this is released, I believe. If it's not, it's every quarter. But each one of these blue dots is a Fed member and their projection for where they think the Fed funds rate will be. So 2026, you can see it goes from current at the end of 2025, 3.6% to 3.3%. Essentially, that's the expectation of where the rate cuts would be. This would be certainly an outlier for expectations currently. You can see how they kind of group around the average here of 3.375. Ironically, I think it's interesting that there are some that actually expect it not to drop at all. So, but there's 3 that don't expect it to drop at all, with the rest expecting some rate cuts. Just how extreme. This is information that the market will pay attention to when it comes out. But at times, other people don't pay attention to it, which, I mean, to me, this gives you the biggest indication of what they're thinking when they go into that room and shut the door. But we think, thinking outside the United States, these are some other, Fed or Fed equivalent rates across outside the United States, so Bank of Japan, the EU, and Bank of England. You can see where those sit. These are impacting the value of the dollar. Really what this does is interest rates and currency rates are very closely tied. And you're seeing some of that impact today. U.S. economic growth, we're actually performing pretty well, and forecasts for 2026 are for anywhere between 2.5% to 3.5%. I will remind you that the consumer, you and me, and everybody here at Townsend, we are the consumer, and that's about 70% of GDP growth. So consumer, as I'll show you, is in pretty good health, and the big beautiful bill. It is forecast that the average tax return will be $1,000 larger than it was last year. So in addition to employment, earnings, compensation support on that, and then incremental support from fiscal policies should help continue to support some economic growth. This is a bit of an anomaly. This is another slide that we are consistent in showing you just from a recession perspective. And this is the leading indicators. So this is a index that follows various contributors as far as an indicator, leading indicator for the economy. So the darker color is they're positive, and the yellow color here is that they're obviously negative. I think historically you see that we don't really, at least recessions overlay periods when leading economic indicator index is negative. I think we've also tried to make the point that there usually is a gap between when they turn negative and when a recession is determined. By the way, a recession is always determined after the recession is over. And so that's usually when they figure out we've been in one and we're already out of it. 2020, that's obviously COVID. But here we are in a rather large and extended period of negative leading indicators with no recession. So I really don't know how to read this, quite frankly. I don't know if this is really indicating anything other than observing that where we are, because there is a fair bit of support for the economy and what's happening. Yes, I do realize I'm getting a little long-winded, so we're going to try to pick up the pace here a little bit. Here we have the consumer price index, so an inflation gauge. This is one that gets a lot of attention. I will just make the point that it is above the core or the fundamental rate that the Fed talks about at 2%. I do want to bring these are the components of the S&P 5 or the consumer price index. You see where the contributors are to the CPI. Obviously, a big pullback in used cars. I just want to make the point here, which people don't realize, is that shelter in the CPI is roughly 40% weighted in this. And how they calculate shelter inflation is they call up actual homeowners, so not renters, homeowners, and they ask them the question what they would rent their house for. And they compare that survey and what those difference in prices are to the contribution to CPI. There must be smarter people than me. I mean, if someone called me and asked me what I'd rent my house for, I don't even know what the answer would be. But I'm sure there's a rather, this is the way it's been done. But to me, that calls into question. But also probably is the reason why the Fed prefers the personal consumption expenditure index. So this is the measure that the Fed pays attention to. There's also a absolute and a core. I think it's worth pointing out the differences of why they look at this. Here the weightings in the contributors of this index are updated monthly as opposed to yearly with the CPI. Importantly, the CPI uses a set basket of things to consider. Included in the PCE is services on the behalf of consumers. So the biggest obvious example here is employer-funded healthcare for employees. And again, housing difference. Housing in the CPI is greater, 40% to greater weight in the CPI. In the PCE, it is 15 to 30%. And then interestingly, also the PCE considers substitutes. So currently in the grocery store, substituting chicken for meat or ground beef as an example. So while the CPI, it is believed that it is historically the PCE has been a lower measure of inflation than the CPI, but I do want to point out, if you follow me, here's the CPI at 2.5 at core and 2.4, absolute. And you see the PCE is at 2.8. So that's a bit of an outlier and not normal. Some numbers on why investors are concerned, and the market. A conversation within the market is the federal budget, which is significantly in a deficit position. Obviously, not as large as it was in 2020 when we were just spending large amounts of money to support the economy. Here you see where we were back in 08 and 09 in the financial crisis. Also, a number that gets talked about is the deficit is about 6% of GDP, which is, and that is what the yellow line is here. But very rarely, do we have a deficit that isn't a negative percent of GDP. Here's looking at total debt as a percent of GDP. Again, argument for the weakness of the dollar and the trade out of the dollar, what we're seeing year to date. Total debt, it's 121%. Net debt is 97%. Well, James, what the heck is net debt? That excludes government-owned U.S. debt. So you could argue that the 97 is probably a little bit better measure than absolute total debt. That being said, you obviously see that this has been increasing and why it's a focus point of the market and paying attention to it. US dollar is getting a lot of focus. This isn't, I have to admit, this isn't a perfect graph, because really the part I want to pay attention to is essentially from here forward. You see that the dollar has been weak relative to other currencies in the world, and also against a basket of currencies. And a hot topic these days that leads into the argument for gold and silver and other precious metals. These have done particularly well last year and have been a little bit more back and forth in 2026 year to date. But the discussion is, and it's a bit of extreme, but I'm very worried about the U.S. marketplace. I'm very worried about the dollar being the lead currency of the world. I'm very worried about the GDP, our deficit, and things like that. I want something that's going to hold its value. Gold, silver does those things. I will caution that the gold market is a global market. The silver market is more of a U.S. market. Our kind of your chief investment officer, that'd be me. I'm much more interested in things that produce things. And so, and just using other forecasters, discussion on these types of things. This should be anywhere between 5 to 10% of your portfolio. Okay, so that's great. So you're buying an asset, and the idea that the markets are going to fall apart, and you're going to put 10% of your portfolio in it. Your other 90%, based on the reason you're adding this asset to your portfolio, would be theoretically wiped out. But you're going to have 10% on the very high side of your portfolio allocated to these metals. I frankly don't see the point. And the other point I would make in this is that these prices are past prior peaks. I will inform you that those past prior peaks are 40 years ago. I'm very confident that our investment meetings with our clients, if we were to add things to their portfolio with an expectation that this asset's going to really start to appreciate, and if it does, it's got the chance to beat its prior peak from 40 years ago. We were just showing slides where the investment horizon was 25 years, the U.S. equity market. Now we're talking about prior peaks from 40 years ago. Certainly we're aware of it. Certainly we know why it is. But I can also communicate that any article being written on gold and silver today is a comment to stay away from it. But at these prices, I should add. Unemployment rates. So why is the economy going to be supported? Here you see the U.S. The underemployment rate still, below its average, and the unemployment rate below its average. So people are employed, people have cash, people have money to spend. Where are they from a debt perspective? Historically, household, debt service is a percent of income. This includes consumer debt, so credit cards and your mortgage. What on a monthly basis of your income is going to service debt. From a household perspective, it's 11%, and the average is 12.5%. So while still, obviously from 2020, this has come up, but we're still in a relatively good position. Just for informational reasons, thought it was interesting, mortgage rates, again, these go off the 10-year at about 6.1%. This is the problem we have. People aren't moving because they've got mortgage rates back here in this range, sub 4. So you're talking about selling your house and a mortgage at sub 4 to go buy a new house at 6. You're not seeing a lot of house movement, and this is existing home sales is showing it. There's a number of things that would need to occur to get the housing market back to where it has been. Frankly, none of them all that attractive, whether it's interest rates, which would suggest a massive recession, house building, which, the house builders aren't building because they're holding price and margins. But this, a home is arguably one of somebody's largest asset, and helps in consumer sentiment, et cetera. Given that we are going into the midterms and there's a lot of noise about that, usually we show this slide in a presidential election year, but these are market returns relative to political events. The left is when there is a Democrat in the White House. The right is when there is a Republican in the White House. And the various bars are controlling essentially the government, so the House and the Senate. My only point here is that most of these returns are in the double digits, regardless of party, regardless of affiliation. And where we have a split, or the Democrats controlling both the House and the Senate, that is the one with a Republican president. That is the one where it's sub double digit, but I still think a 9% return for the SP 500 is something where you would really, our advice would be remove politics from your portfolio in any chance you can. And then lastly, our last slide. This is really just informational. 25 tax rates and income brackets or income levels within those brackets for 2025 and 2026. As is the norm, I have spoke way longer than I thought I'd be speaking, but trying to give you guys, everyone, a lot of information. The rest is our disclosures, definitions. Importantly, these are my opinions, and